Hi, I'm Billy Gwaltney, and this is the CYA Podcast. This show is for the physician who understands the importance of protecting everything you've worked so hard to achieve. Each week, I'll bring you tips and advice to help you cut through the clutter and misinformation and show you exactly what you need to preserve your income and way of life. If you're ready to achieve the peace of mind that only financial security can bring, let's get started.
Hey guys, welcome back. You're listening to the second part of last week's episode. Let's jump back in.
So a few specific questions. I end up, like I mentioned earlier, helping most of our clients with life insurance, at least addressing or starting to address that early in their career. What is your philosophy? Do you discuss life insurance? I assume that's part of the maximum protection part, and you go through that, and you and I have talked about that. What are your thoughts on how much if someone comes to you and says, how much should I get and what type should it be? What are your thoughts on that?
Yeah, so we use those principles to help with that decision, right? Because that's such an important one as far as our overall planning goes, right?
Mm-hmm.
So principle number 2 is maximum protection. Well, do most clients even know that there is a maximum life insurance that they can get?
Yeah, not until we discuss it, typically.
Yeah. Pretty much in 23 years of doing financial planning, I've never met with anybody who could tell me what their maximum was before they talked to me. They didn't even know there was a maximum. So life insurance companies have an underwriting limit based on your age and your income, and that's your maximum. That's what you can get. You can't get more than that. I kind of relate it to homeowners insurance. So let's say, Billy, your home is worth $500,000. That's the cost to rebuild your house. Will the homeowner's insurance company let you buy $1 million dwelling coverage on your house?
I assume not.
No. And why not? Yeah, you're right.
Because it would impact my decision on what to do with that house, perhaps.
Yeah.
I guess.
Yeah. Why don't disability insurers offer 200% of income replacement?
They don't want to give anybody too much of an incentive.
Yeah.
To get creative.
That's right.
Yeah.
So insurance companies don't incentivize a loss, right? They replace a real asset. So what does life insurance actually replace? Life insurance, in my opinion, is misnamed. It shouldn't have been called life insurance. I think if it was named better, more appropriately, people would treat it the right way. Like homeowners insurance, you know exactly what it's going to do, right?
Right.
Life insurance does not replace the value of a person's life, right? Because that value is infinite. You can't put a price on that, right? Life insurance replaces income and assets. So when I meet with a client, I'll say something like, so Billy, how much of your income don't you want your spouse to receive when you die?
Oh,
and it's always better if your wife is sitting there with you.
Yeah.
You know,
my answer would be the same either way.
Yeah, good.
I want her to get it all. Yeah, I want
to
her
get
to
it all, right?
Right.
So what if I were to tell you you couldn't give her all of it, right? Would you want as much as you could get?
Yes.
Yeah. Okay. It has nothing to do with needs. By the way, you have no idea, right? Unless you have a functioning crystal ball, which if you do, you don't really need financial planning, right? But yeah, it's not about needs. It's about replacing an asset. Just like when your home burns down to the ground, you don't look at it and say, wow, I didn't really need all these bedrooms. You want the whole house rebuilt, right? And that's the purpose of life insurance. So with life insurance, the how much, it's not about how much you need. You don't really know how much you need unless you can predict the future. But the real answer is, why not have the full replacement of your income as much as possible, just like you would with disability insurance, just like you do with homeowners insurance on your house. If it burns down, it has nothing to do with how much of the house you needed. It has to do with the replacement of that asset.
Nice. Okay.
Does that help?
Yeah, that's good. That's good.
And then the second one was type, right? The second question on that.
Mm-hmm.
So type is an interesting one. So first, I would say the priority is the amount of protection, because if you were to die, Billy, I can tell you for sure that your wife doesn't care what type of life insurance it was.
Absolutely. That's right. That's a good point.
What she cares about is how much, right? That's all that matters in that situation. So that's the priority, is the amount, not the type. And unfortunately, too many people in the life insurance business focus on the type more than the amount, and then they
Mhm.
cheat their clients out of what they probably should have had.
Right. Yeah, I see that.
So when it comes to type, though, so life insurance is a unique and interesting tool, financial tool, because the IRS gives it amazing tax advantages, right? So not only is the death benefit tax free, but the cash growth within the policy is tax free, and it can be used penalty free. And if we look at all financial tools within the United States, financial accounts that are tax deferred or tax free, none of them, other than life insurance, allow you to access your money above and beyond what you've put into it with no tax and no penalty before age 59 and a half. So that makes it kind of a unique tool, right? I mean, 529 plans are really popular because they're tax free. You can use the money tax free for college, right?
Right.
Or an
Right.
HSA is valuable because you can pay for medical expenses tax free for medical expenses, right? How would you like an account that's tax free for any purpose?
Hmm.
I mean, would that be valuable?
I would think so. Yes.
Yeah.
Yep.
So that's where we get into types. There are basically three types of life insurance. There's term, and there are a bunch of subcategories within that. There's whole life, and there are some subcategories below that. And then there's universal life, and there's subcategories below that. And each one, has its unique features. Like term insurance has no cash buildup. There's no access to
It's
money
cheap.
throughout your lifetime. Yeah, it's super cheap. It has a time and a place, and I compare it to renting.
Yeah.
When I first got married, I was glad I could rent. I didn't want to live with my parents or her parents. And
Right.
so we were able to rent and have our own autonomy. But I didn't want that to be a long-term solution because, I wasn't going to build equity. I
Right.
knew I was losing every dollar I put into it, and I wasn't going to get it back. Now with term, there's a chance you could die, right? So there's a chance you won't be losing all of your money, but that chance is very low. It's a very
Hmm.
low possibility, which is why the premium is so low. Whole life's different. Whole life gives you guaranteed growth of cash within the policy that you have access to throughout your lifetime. You can use it anytime for any purpose, tax free and penalty free. And it's guaranteed, depending on your age, it's guaranteed to exceed your premium paid, which is pretty awesome. That's the only type of life insurance policy that can actually give you that promise.
Hmm.
And so ultimately, what's the cost of whole life? Some people say, well, cost is how much I put into something. That can't really be the definition of cost, can it? Because Billy, every time you get paid, where do you put your money? Where do
In
you
the
put your
bank.
paycheck? In the bank.
Yep.
And
Yep.
do you say the bank cost you your whole paycheck?
No,
Why don't you?
because I can get it back. Because they.
Yeah.
Yeah. Yeah. Okay.
So that's kind of, so the real definition of cost has to be input minus output. That's what the real cost is. So if at some point in time in a whole life policy, the cash value is guaranteed to exceed the premium paid, then what did it cost me?
I guess there could be an opportunity cost, right? If
Except,
the
is there
other
an
thing,
opportunity cost in a bank?
I'm not sure.
Okay,
No.
that's a trick question.
Yeah, I was about to say. Yeah.
We don't feel like there's an opportunity cost in a bank where we put our money because we have access and use of the money, right?
Right.
So
Okay.
when an opportunity comes, can I take advantage of it if the money's
Right. Yeah.
accessible? Yes.
That's right.
So we
Yeah.
say a bank doesn't have opportunity cost. Well, if all of the money I put into whole life insurance also is available for use, is there an opportunity cost?
I guess not because you can use it for other things.
Yeah,
Right.
for any purpose.
Okay.
The IRS doesn't limit me on what I can use it for. I can use it for any purpose. So
Okay.
ultimately, there is no opportunity cost with whole life insurance. Universal life insurance is a little bit different. It's kind of a combination. It's a hybrid between term and whole life. It gives you the cash value like whole life, and it gives you the death benefit like term. But another way it's close to term or similar to term is that there are increasing costs within it. Okay. And unlike whole life that has no costs within the cash value, there are costs within the cash value of universal life. And so what happens is those costs increase over time. The older you get, they compound actually. And every universal life policy says if the cash value is ever insufficient to pay the monthly cost of insurance, the policy will lapse with no value.
Right.
And
Hmm.
so to me, I I see less of a place. I'm not saying there is never a place for universal life, but I see less of a place for universal life because it's a maybe. With term, you know what you're going to get. You pay your premium. As long as you pay your premium, the death benefit's going to pay, right?
Right.
If you always pay your premium on universal life, you may not actually have a death benefit at the end because of those increasing costs inside. With whole life, the premium is guaranteed and the death benefit's guaranteed. So, which type is right? It just depends on each person,
Right.
that you meet with and what their situation is and what they're trying to accomplish. And, it's a tool for the job. So
Yeah.
we try and find the best tool for the job.
Nice. Okay. I like it. Can you speak a little bit about this? Can be a popular notion on some physician blogs and resources about self-insuring. It seems like the goal for a lot of young physicians would be to get to the point where I can self-insure, primarily maybe from a life insurance standpoint, sometimes from a disability standpoint, but it seems the place where I hear it more often is in the life insurance topic or conversation. Can you speak into that a little bit? I know you've talked about it some with the principles, but
Yeah, absolutely. So what is self-insure? What does it actually mean to self-insure? Self-insure means that you don't have any insurance, right? You're canceling your insurance. I can see why that sounds appealing, right? I can understand why that would be appealing because who likes sending money to an insurance company?
right. That's a
Yeah,
good point.
nobody.
Yeah.
You know.
Right. Right.
So it sounds good. The problem is that you actually will insure. You're going to insure one way or another. And so you're either going to insure with insurance or you're going to insure in another way. And I always talk about it like this with a client. Have you ever hammered a nail with something other than a hammer? And I think most people
Yeah.
have.
Yeah. If you have to, yeah.
Yeah. And is it as effective though?
Never. No, no
Yeah,
way.
it's never as effective. So when we talk about self-insuring versus insuring, it's kind of using a hammer versus using something else, not a hammer, right? So I like to talk about an analogy to help people understand what the cost of self-insuring is, because I think that's the other misconception maybe related to self-insuring is that there's a no cost option, right? Like if I self-insure, then there's no cost. And the reality is that there is a cost to either decision, right? The question is which one costs more? And to help people understand which one costs more, I talk about homeowners insurance, okay?
Okay.
So when you have a mortgage on your house, does somebody make you get homeowners insurance? Do you have
Yes.
to have it? Yeah.
Yeah.
The lender requires it, right?
Right.
And not only that, but they require a specific kind. They call it full replacement coverage, full
Mm-hmm.
replacement cost coverage. So you have to have that, and if you don't get it, then the lender themselves will issue a policy, and it's extremely expensive, and they'll charge your account. They'll charge your escrow for it.
So
So
you're gonna have it whether you want it or not.
you're
Right.
going to have it. Yep.
Right.
Now,
Okay.
once your house is paid off, does anybody make you get homeowners insurance?
No.
No. So you're free to choose. At that point in time, you could say, you know what, I'm not going to have homeowners insurance anymore. Okay. Now, how many people actually would stop paying for homeowners insurance once their house is paid off?
I wouldn't. I don't think I've ever met anybody that's admitted to it. But
Do you know any financial guru who recommends people stop paying for homeowners insurance on their house once it's paid off?
no.
I've never heard it. Never heard it. Okay. So that's not an advice that's given. It's interesting. Why not? We'll talk about that here in a second. But let's say, Billy, just for fun, let's say that your house would cost $500,000 to rebuild. Okay.
Mhm.
That's probably a low price in today's world, actually, after all the
Mhm.
inflation we've had.
Right.
So let's say it costs 500,000. Let's say you had $500,000 in cash. Okay. And you could
Okay.
put that $500,000 in the bank, and that could be your insurance on your house. And you
Right.
could cancel your homeowner's insurance. Would that be a good idea? Do you think that sounds like a good idea?
No. No. It doesn't.
Okay. And why not? By the way, and people intuitively know this, I think, when I talk to them.
Well, because the cost for the insurance is very small compared to me having to write a check for the full 500 that I couldn't use for anything else.
That's an important point. The 500,000, if you put it in the bank and that became your insurance, you couldn't use it for anything else, right?
Right.
Because if you did, then what happens to the insurance on your house? If you were using the cash as the insurance on your house and you use it, then what?
I'm in a bad spot.
Yeah, then you have no way to replace your house. You have no way to
Right.
protect it. Okay. So self-insuring on their house is, everybody knows it's a bad idea, right?
Mhm.
Because it costs you more than if you were to pay for insurance. If you bought insurance in that same scenario, I mean, we're talking maybe less than a few $1,000s a year, right?
Mhm.
Now what can you do with the $500,000?
Whatever you want.
Whatever you want. That's a huge key. So what if life insurance really is asset insurance? Okay? Because that's what it actually replaces. It replaces assets. It replaces income. It shouldn't have been called life insurance. So when people go to retire, the financial gurus and the financial institutions, even the insurance companies themselves, are telling you should self-insure. Okay? Because what's the most popular type of insurance, by the way, of life insurance?
I guess term insurance.
Term,
I would
which
think.
is meant to end at a certain point in time, right? Typically before you die,
Right.
right? Is that on purpose? I think that's accidental that they're promoting that.
It's a cash cow for them.
It's a cash cow. Is it not right in line with the rules of financial institutions?
Mm.
You know, that they want our money. They just want us to pay premiums for most of our lives, and then before we die, cancel it so they don't have to pay a death benefit, right?
Mm.
Okay, it is not on accident, right? So then they self-insure. Does it benefit financial institutions if you self-insure? Let's say you have all your money in a 401k and now you're using your 401k not only to produce income for you in retirement, but also to insure your surviving spouse.
Mm.
How quickly are you going to spend that money?
I assume it's going to be pretty steady if I need it for income.
Yeah, but you're probably going to try not to spend it, right? Because
Oh, I see.
if you spend it, what's going to be left for your surviving spouse?
Nothing. Yep.
Yep. So isn't that in the best interest of financial institutions that you actually are a little bit afraid to
Oh, I
spend
see
your
what you're
money?
saying. Yeah. Wow. Okay. I see what you're saying.
Okay. So what's the cost of self-insuring for people who go into retirement? They cancel their asset insurance, aka life insurance, right? They cancel their life insurance. Now what becomes their insurance? How do they protect their surviving spouse?
Keeping their assets intact.
Yep. So in
Not
other
spending.
words, not spending it, not
Right.
enjoying it. Okay.
Right.
Which is exactly what financial institutions want, right? So does that cost more or less than what if you had insurance? What if you kept insurance in place? What if you were able to have full replacement of assets upon death? Okay. Now what can you do with those assets? Now what can you do with your 401k? If you
Whatever
know
you
the day
want.
you die, all of it's going to be replaced.
Yeah. Whatever you want. So the person out there that's going, yeah, okay, I get the homeowner example because it's like you said, it's a few $1,000s. That's it.
Yep.
The insurance agent just showed me a $30,000 premium for whole life insurance or 20,000. That's not comparable because then I can't invest in anything else because it's all going towards life insurance. How do you respond to that? And I know the devil's in the details
Yeah.
because you don't know the situation. But if that's the thought process someone has that like this asset insurance you talk about sounds good, but it seems really expensive.
Yeah. So homeowners insurance is a lot like term insurance, right? In that there's no cash buildup. There's no access to money. Like if my house doesn't burn down, do I get any of that money back?
No, good point.
No.
Okay,
Okay.
right,
So
right.
it's like term insurance. So the premium's lower. Also, what are the chances of your house burning down versus the chances of you dying eventually?
Yeah, it's not comparable. Yeah,
It's not
really
comparable.
small. Yeah.
So actually, if you look at the premium, okay, just looking at premium to death benefit, it's very similar to homeowners premium to dwelling coverage amount. It's not
Mm,
actually that much different. Then
okay.
if you factor in, okay, well, what if, I mean, how many of us would pay a little bit more on our homeowners insurance if we had access to all of the money we ever paid in our homeowners insurance?
Yeah. Okay. Yeah, that would be
I'd
worth
pay a little
at
bit
least
more
see.
to,
It'd be worth at least seeing for sure.
yeah,
Yeah.
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 So there's a lot of, like you said, the devil's in the details. There's more information that we need to know to make a better decision, right? But it's not so simple as most of the financial planning world has tried to make it, right? Which they're like, just self-insure and then you don't pay the premium anymore. Okay, but there's a cost, right? What's the cost of that decision? And how does it compare to the cost of keeping life insurance? And, it's surprising to most people to find out how much less expensive it is, how much less costly it is to actually insure throughout retirement than to self-insure.
Right. That's good. So, kind of just a few questions. They're kind of all over the place, perhaps. But when you say financial institutions, I can see where the default would be, okay, you're talking about banks, but I don't keep my money in the bank. I'm gonna put it with Vanguard, and it's going to be in my self-directed stuff or 401ks and all that. Are you lumping that? When you talk about financial institutions, are you talking about them as well, where they're incentivized for me to keep my money in those accounts the same way the bank is, and they use it for other things, or is that a different category?
So when does Vanguard want you to get your money back? When do they want you to pull it out?
I guess never, right? Because
Yeah.
they get paid. They get paid on that.
Yeah, they have something called assets under management, right? They get paid for assets under management. In other words, they charge fees, right, based on the amount of money that they're managing for you. Okay, so they actually have what I would say a legal conflict of interest. Okay, but they don't ever really talk about it very much, right? Because do they have a financial disincentive for you to ever take your money out? What happens to how much money they make if you pull money out?
I guess it goes away.
It
Yeah,
goes down, right? Like
yeah,
if you pull
yeah.
money
That
out,
money goes away. Right, right.
right,
Okay,
then they can't charge a fee on it anymore. So they have a,
right,
a negative financial recourse for you taking money out. So unless we believe in our hearts that they're just benevolent, they're doing it for money, right? They're doing it to make money. And I'm not saying that's a bad thing. Doctors
right,
do what they do a lot of times for money, but not
sure,
entirely, right? We
right,
hope that doctors that we work with that help us care about us beyond the money, right? And I'm not saying all financial institutions are evil or they're, just self-motivated, but they do have a clear conflict of interest, right?
mm,
If they're managing my money and they get a fee for how much money they manage, and if I pull money out they get less of a fee, that's a financial disincentive. It's a conflict of interest, right? So they actually, from a financial standpoint, are encouraging us to never touch our money. And I think people innately know that. We can say about banks, that's true with banks. That's true with insurance companies, life
right,
insurance companies and disability insurance companies and health insurance companies. They're the same, right? They want to make a profit.
right,
They want to pay out as little as possible, right? But that's the importance of contracts, which you do such a great job of going into detail. The insurance company is never going to go beyond the contract, right?
right.
They're never going to be like, you know what, this is what our contract says, so, but we'll pay you more than what it says.
Yeah, well, that's
Never.
the it's all about the language, because they're going to default to whatever the language says. If the
That's right.
language says they don't have to pay, they're not going to pay you because they care about you.
Which is proof. Yep.
That's yeah. The only reason they're going to pay someone is because the contract says they have to,
Yep.
and that's where there's no the devil's in the details, and
Yep.
it's got to be in writing for sure.
So think about Wall Street, and I'm not trying to be too mean about Wall Street, but what kind of contract do they have with their investors? What's their contract? What does it say? Do they have a promise to the investor?
Not that I'm aware of.
Yeah.
I mean,
In
I guess
fact,
to do it legally, whatever that whatever
yeah, they're
rules
going
they're
to
going to
follow
play by,
the
right?
SEC rules, right?
Right, right,
They're going to follow the rules that are established, right? But ultimately, it says in every prospectus that this is not guaranteed. There's no guarantee in this contract, right? You
like
set up this
nothing.
account.
Like even
Yeah,
even what you put in isn't guaranteed.
right. That you
Yeah,
can lose value. That's what it says. I'm not saying it will. I'm just saying that's what it is. So when we deal with financial institutions who have a conflict of interest with us, right? They want our money and they want to keep it as long as possible. They want to give back as little as possible. If we have no contract, right? If there's no guarantee of anything back to us, then what are they going to give us? Ultimately, it's an important thing to think about, I think. And that's why, I encourage people to invest in themselves, their own ideas, their own property, their own businesses, things like that, because that's
so
something. they can have some influence and control of.
Right. So wrapping up, you've got 3 rules of investing. Can you give a quick definition of investing compared to the definition you gave for saving? And then what are those 3 rules for investing?
Yeah, the word invest, it sounds like investigate, doesn't it? They have the same root word. And that's not by accident. Okay, so invest really means to investigate. It means to learn. It means to, and actually, if you pull it up in Merriam-Webster, it says to earn a return for a service or work, okay, provided. So investing actually is earning, and if you look up the word earn, you find out that it's based on effort and time and stuff like that. So the medical professionals who listen to your podcast know exactly what investing is because they invested in their education. They invested in their profession. That's what investing actually is. The financial world, whose objective is assets under management, okay, they're trying to tell us it's something different. That's not what investing is. The investing is putting your money into something where you give up control, you give up expertise, and you hope for a rate of return, right? You hope that it grows in value.
They've hijacked the word and changed the definition.
Yep. In fact, they don't even use the word invest. Like, what do they call IRAs and 401ks and 403bs? They call them retirement something account, retirement savings. Okay. Now, remember the word save means to remove from possible injury, to protect, right? You're not putting it at risk. You're actually taking it away from risk. That's what saving means. So are people actually saving or even investing when it comes to the real definition of those words? When they're putting money into their retirement accounts and stuff like that? They're doing neither. They're doing neither. So I would encourage everybody who's listening to this to look up the word gamble. Okay? Look up the definition of the word gamble. It means to play a game for an uncertain outcome. Okay? To play a game for money, and you're doing it and it's an uncertain outcome. Okay? And that's what gambling means. So I don't think most people realize that what they think they're doing is saving and they're investing for their future, right? But they're doing neither. They're just gambling. But they don't really know that.
Right.
And that could be true. I'm not just bagging on Wall Street. I'm saying if you're doing that in real estate, or you're investing in, a real estate syndicate, or, some other thing, some business, but you don't know what you're doing, you give up control, you're just chasing returns, you're gambling. That's not investing. So anyway, so those are 3 rules for investing: are invest in what you know. Okay. In other words, invest in the things that you're either an expert in or that you're willing to become an expert in. Okay. Invest in what you can control or influence, right? Don't you want some control or influence? Going back to the principle of accountability, if you give up accountability, will you be successful in any area of your life if you're not accountable?
No, I don't think so.
Yeah. But in the financial world, we're kind of conditioned to think it's okay to give up all of that.
Right.
And somehow it's going to turn out okay, even though in no other part of our life has that been true.
Right.
Okay. And then the third rule is don't chase returns. If the only thing a person knows about a potential investment is the possible rate of return, then they don't know enough to invest, right? They don't really, that's not a replacement for real research. And ultimately, it's going to lead people to falling for scams, right? And falling for hype and marketing. And so they're going to lose their money eventually.
Which seem to be everywhere now with the, I mean, they're just, they're a lot more prevalent than I think most people even realize. Yeah. Man, this has been really good. Really good, Kyle. How can people get in touch with you if they want to reach out to you?
Yeah, they can.
We can put this in the show notes too.
Yeah, my email is probably the best way to reach out to me. So Kyle at uniqueadvantage.biz. And, you can go to our website as well, uniqueadvantage.biz.
Okay.
And learn more.
Principles-based planning is the book, right?
Yeah. And you can find that on Amazon.
Okay. Awesome. Yeah. Awesome. Thanks for being with us. Those listening, feel free to text me anytime to have a conversation. My number is 704-270-2376. And happy to discuss your situation anytime. And until we meet again, thank you. This is Billy Gwaltney. See you next time.
This is thepodcastfactory.com.